In the last class, we have completed calculation of long-term capital gain in case of listed securities acquired on or before this date. Okay, so these are the provisions also we have already covered while discussing the illustration. In case of asset distributed on company liquidation and other things also, we have covered all these things along with the illustration, so you don't need to study separately. The 8 points is not required for the inter level. So, surplus on sale of shares and securities. Now, if I ask you whether it's a capital gain or PGBP, how can we answer? Usually, it will be considered as capital gain, but you consider this being the PGBP and assessed as PGBP for a long period, then you can continue to assess under PGBP head itself. This is the option of the assessee. But once it is taken as either CG or PGBP in any assessment year, then you have to continue the same for all the subsequent assessment years. Right. Unlisted shares usually treated as capital assets. In case of PGBP, the tax rate being the normal. In case of capital gains, the tax rate is decreased one. Okay, lower tax rate will be there, probably 10% like. Right. In case of long-term capital gain. In PGBP, regular tax rate, even 30% will also be applicable. But of course, you can claim some expenses also from this income to be deductible. Like you have the office for operating the buying and selling of shares, and you have appointed some staff, and those expenses can be debited. If you are considering this being the PGBP, usually capital gains will be the right choice for the majority. But there is an option, you understand. Or has been living in a rented accommodation since 1993 and is paying a rent of rupees 4,000 per month. The landlord got the house vacated from R on 16/7/2024. So, and paid rupees 15 lakhs for vacating the house. What happens here? This is nothing but tenancy right. A tenant occupied the property for a longer period usually demands some compensation for vacating the house property, may be called as a tenancy right. Tenancy right is also intangible assets like goodwill, patent, and all, right? In this case, whatever the amount gets no landlord and tenant. So around 15 lakhs is paid by landlord to tenant for vacating. Then it is called tenancy right. And for the tenant, this 15 lakhs is considered as taxable income. Taxable income. Is that clear? For tenant. And this becomes capital gain. Capital gain. Compute the capital gain, if any, in the hands of R. Okay. Later on, R transfers that tenancy to somebody else, then of course you can enjoy the benefit also, no problem. So, sale consideration of the tenancy right is 15 lakhs. What is the cost of acquisition? 0. So, entire 15 lakhs will be considered as long-term capital gain. In some cases, R can transfer the tenancy to X at a cost of rupees 15 lakhs. Now, for R, you know, this will be the capital gain. For R, 15 lakhs will be the capital gain. Later on, Y can surrender the house property to landlord and he may get 20 lakhs. Then the difference between 20 lakhs and the 15 lakhs will be the capital gain in the hands of X. So, if the tenancy right is self-generated or purchased. For R, it is self-generated. For X, it is purchased. In case of self-generated, the cost of acquisition being 0. If it is purchased, then you can take the actual cost of acquisition. Hope now you'll be able to understand this one. Trademark, tenancy right, brand name, Lumars, here tenancy right. In case of cost of acquisition of the tenancy right, provided if it is self-generated nil or it is purchased from another tenant, then actual cost will be considered. Hope you will be now able to understand this logic. Now, Usha purchases 1000 equity shares in X Private Limited, an unlisted company, at a cost of rupees 30 per share, brokerage being 1% in January 1997. She gets 100 bonus shares in August 2000. She again gets 1100 bonus shares by virtue of her holding in February 2008. Original shares purchased in which date? Jan 97. And bonus share number 1 purchased in which date? 2000. Again another 1100 bonus shares purchased second time in 2008. Okay. So cost of acquisition 30 rupees per share, the number of shares being 1000. First bonus share being 100, subsequent bonus share being 1100. Actually, bonus share will be getting at free of cost, 0. And then the fair market value on 1st April 2001 being 80. So you have to consider the fair market value on 1/4/2001, which is 80, 80. This is acquired after this date, so not applicable. Between these two, whichever is higher will be taken as your cost of acquisition. Cost of acquisition being 80, 80 dash. Now, she transfers all her shares for rupees 200 and brokerage paid. So, sale consideration. Sale consideration. 200 minus 2% 4, 196 being net sale consideration for every share. 196. 196. 196. As it is being the unlisted share, you can claim the you can claim the indexation benefit also. As the sale happens on this date, up to 23rd July 2024, you have the chance to index. Thereafter, you are not eligible for indexation. Okay, instead of 1st July, if it is being 1st August, you can simply subtract the cost of acquisition. You cannot index the value. So, if I am subtracting the cost of acquisition without indexation, 80, 80, 0, the ultimate value being long-term capital gain. Ultimate value being long-term capital gain, 116, 116, 196. In case of indexation, you just go and refer Singar Academy text. It's also there. So I use the indexation value. So 196 into current inflation index being 363 divided by inflation index applicable in the year of acquisition or base year 100. Okay. So if you are using the indexation command, what's the value? 196 into 363 divided by 100. Oh, okay, 80, 80, sorry, 80 into this one. Come on, get me the value. 290, 290. The last scenario being 190, no, so no indexation. So here there is a loss, here there is a loss per share basis. Multiply with the number of shares to find out the total loss. Okay. Anyhow, this is what about the indexation benefit, right? It's all about to apply for a short period. Usually, such a short period provisions will not be asked in the examination. Okay, usually. Anyhow, the next year it's going to be scrapped. So only if it is purchased within this period, then this will be applicable. Otherwise, it will not be. As far as my concern, in this particular examination, capital gains will have lots of importance for the latest provisions without indexation. Indexation is applicable up to 23rd July only, no? Next year onwards, we don't claim any indexation benefit except land or building, land and building. So for the rest, we cannot claim the indexation benefit at all. So only for the short duration, this provision is applicable. Yesterday's newspaper, today is waste paper. So it's a newspaper, like tomorrow it will not be applicable. So you just understand. Clear. That's why I just simplified the calculations rather than going in detail. Let's now move on to the next one. R holds 1000 shares in Stat Minus Limited. Okay. An unlisted company acquired in the year 2004-5 at a cost of rupees 75,000. So cost of acquisition being 75,000. How many shares? 1,000 shares. Sale consideration. He has been offered right shares by the company in the month of April 2024 at rupees 160 per share in the ratio of 2 for every 5 shares. So 1,000 shares, right shares offered 2 for every 5. Then 400 right shares may be offered. 400 right shares may be offered. He retains 50% of the rights and renounces the balance. So here 50%, 200 shares acquired by paying the issue price for right shares 160, and balance renounced in favor of Q for rupees 30. Another 200 is given to Q at rupees 30. Is that clear? Now all the shares sold by R for rupees 300, all the shares. So in case of R, original share 1000, right share purchased another 200 rupees. What is the cost of acquisition for the right shares? Actual amount paid for acquiring the right shares to the company will be considered here 200 into 160, 32,000. Am I right? 32,000 will be the cost of acquisition. Sale consideration. Sale consideration. All the shares are sold at rupees 300 each. So 3 lakhs and 300 into 200, 60,000 rupees. And this will be short-term capital gain because the period of holding is less than 3 years. Unlisted shares, right? In this case, long-term capital gain. In case of long-term capital gain, indexation is applicable, but here indexation not applicable. Right. If you are applying the indexation, current inflation index being 363 divided by inflation index applicable in the year of original acquisition of the share 2004 and 5. The inflation index in 2004 and 5 being 113. Then rather than index cost of acquisition, you can take the index to cost of acquisition, which is 2,40,929. And long-term capital gain in this case being 59,071. Here short-term capital gain being 28,000. What about the renouncing the rights, sir? 200 shares. So renouncing the right, where we can get around 6,000 rupees. For the renouncing the right, what is the cost of acquisition? Assume this is being 0. Already I explained in detail earlier. 6,000 minus 0, 6,000, that is also short-term capital gain. Clear? And Mr. Q sells his shares in December 2024 for 280. So Q also sells later on. Now we are going to consider for the Q's point of view. Sale consideration being 280. What about the cost of acquisition per share? 200 shares, you know. What is the cost of acquisition per share? The amount paid for right plus the amount paid for subscribing the shares 160. 190 being the cost of acquisition. 90 will be the short-term capital gain. The period of holding is less than 1 year. So now you multiply with the number of shares 200, then 18,000 will be the total short-term capital gain in the hands of Q. Clear? Now, determine the capital gain or loss on transfer of listed equity shares. STD paid both at the time of acquisition and transfer of shares. And units of equity oriented mutual funds. So we have been given listed equity shares and equity oriented fund also. For that also STD paid at the time of transfer. In case of units, you need to pay the STD only on transfer, not at the time of acquisition, because you are getting it allotted directly from the mutual fund company where you don't have the STD. For the assessment year 25, 26 and tax, if any payable thereon in the following cases, assuming that these are only transaction covered under section 112A. This provision will be falling under section 112A. Okay. So as per 112A, what's the provisions you have to follow? Sale consideration minus cost of acquisition. Under cost of acquisition, whichever is lower of one, whichever is higher of, whichever is higher of one, actual cost of acquisition, two, fair market, whichever is lower of fair market value on 31/1/2018. You can remember the date easily because 1st February is usually budget date. Thereafter, we have 2 months to be implemented from the next financial year onwards. Okay. And second one being actual sale consideration. Now, Mr. Prasun purchased 300 shares on this date, 2017. How many shares? 300 shares. At a cost of rupees 400 per share. So, cost of acquisition being 400. He sold all the shares of A Limited on 31/8/2024 for 1,200. Sale consideration being 1,200. Okay. The price at which these shares were traded in National Stock Exchange on 31/1/2018 is as follows. So now we have to consider the fair market value. Fair market value. How can we calculate the fair market value? Clear. As on 31st January 28, 2018, we have three prices. Highest, average, lowest. Among the three, which value will be taken? So earlier we came to know that we have to take the fair market value as on the specific date, 31st January 2018. If we are offered with the 2 or 3 different rates, which rate will be taken? Very simple. Highest price will be taken. 700. Highest price is considered as cost of acquisition means what happens? From the sale consideration, you are allowed to deduct the highest value to show lower gain as your taxable income. So it's a favor given to shareholders or investors, right? Now, between these two, whichever is lower is this one. So I'm eliminating between these two, whichever is higher, again 700. From the 1,200, 700 is subtracted. So 500 will be the capital gain, long-term capital gain. Now, long-term capital gain. Now what happens here? Okay. You can consider total long-term capital gain. Total long-term capital gain being, you have to multiply the 500 with 1,200. What is the final value? 1,50,000 rupees. 1,50,000 rupees. Now, tax on this. Tax on this. Actually, in case of long-term capital gain under section 112A, 112A will be total long-term capital gain by selling the shares minus 1.25 lakhs multiplied with the 12.5%. Tax rate in this case being 12.5%. Okay. So while learning the tax rates, I have completed the basic tax calculations, not with respect to the special tax rates applicable for the capital gains. So after completion of this, immediately I just go and cover the tax rate calculations once again so that you will be able to understand these calculations comfortably. Under 112A, the tax calculation is this way only. Out of the total long-term capital gain, 1,25,000 is exempted. Balance will be taxable at the rate of 12.5% flat, not whatever the income level you have, not the highest tax rate, probably 30%. You may be falling under 30% tax rate, though you may fall more than 30% tax rate, yet you have to pay only 12.5% on this value. Come on, what's the value? 3,125. Of course, you can add health and education cess at the rate of 4% on this, which is 125. So the ultimate tax payable on your capital gain being 3,250. If it is clear, text me. So we'll move on to the next one. Make it faster. Online students, come on, keep responding. Now we'll move on to the next one. Mr. Raj purchased 200 units of equity oriented funds, Fund A and Fund B. Fund A and Fund B. So, securities include not only equity shares, even equity oriented mutual funds also part of securities alone. So, here not only shares, he has invested in equity funds also. Two types of funds he purchased, Fund A and Fund B. And on 1/2/2017 at a cost of rupees 550. So as it is before the date of the specific date, 31st January 2018, then the rule will be applicable. So sale consideration minus what? Whichever is higher of actual cost of acquisition, second being whichever is lower of fair market value on which date? 31st January 18, and second being sale consideration. So then you'll get the long-term capital gain here. Here, this one is purchased before this date, so at a cost of rupees 550. Okay. I think Fund B also purchased at 550, Fund A also at the same date. The units were not listed at the time of purchase. At the time of purchase, it's not listed. Okay, so unless it is listed, you may not pay the STT, right? So it is also not listed at the time of purchase originally. So as it is not listed, then fair market value will be in trouble. We may not know the fair market value. If it is listed, means it is traded in the stock market. If it is traded in the stock market, there will be quote available also in majority cases. If it is not traded in the market, then you don't have the quote. Then the fair market value will be trouble here. Let's see here. Unit A were listed on 1/1/2018. Anyhow, happy. The first fund got listed before the specific date, 31st January. So it's listed on 1st January itself. So we can safely take the quoted value on 31st January 2018. So Fund A, 31st January 2018, three rates are there. Then which rate can be taken? Highest of the three rates can be taken, 750. 750. Fair market value that date. And unit B were listed on the next date, not on exactly 31st Jan. On 31st Jan, this Fund B not listed. So as the Fund B is not listed, I am not able to get the fair market value on 31st January 2018. Then what can we do, sir? In that case, you just try to find out the fair net assets value somehow based on the assets and liabilities value. So from the assets minus liabilities, you will be getting the net assets. Divide that by number of units. In case of share capital, number of shares, here number of units. If you divide, you will get the net asset value. So you get the net assets value on 31/1/2018. This is the second option. If you are not having the listed fair market value as on the specific date, then you can take this one. So 950. And Mr. Raj sold all the units for 900. So rest of the things are very simple. Okay. Among the three, whichever is lower, and between these two, whichever is higher, this will be final. Here between these two, whichever is lower is 900, and between these two, whichever is higher will be 900. 900 minus 750, 150 is gain per share. Here 900 minus 900, no profit, no loss here. Clear? Hope now you'll be able to understand. Between these two, whichever is lower, and fair market value 750 only, no. Yeah, okay. Now what is the number of shares? 200. So then here the value be 30. Here also assume 200, so 0. $1.25 lakhs. Here it's a standard deductions, like in case of salary, default 75,000 will subtract now. Similarly, in case of long-term capital gain, falls under section 112A, exempted to the extent of 1,25,000 rupees. We'll study that along with the tax rate calculation. So after completion of that, so I'll cover up some tax rates for this long-term capital gain alone. Clear? Make note of it. So securities in this case include shares, scrips, stocks, bonds, debentures and all. Should not have confusion. That's why I have given this list. Even it includes the government securities, rights or interest in securities, like right shares. All these things are falling under securities only. Now, Mr. Mithun purchased 100 equity shares of Mrs. Good Money Company Limited on 1/4/2009 at the rate of 1,000 per share in public issue. This was purchased very long ago, okay, by paying security transaction tax. And bonus share also allotted 1:1 ratio on this date. Any bonus share after 31st January 2018, cost of acquisition will be always assumed to be 0. Okay, and dividend will be considered as income from other sources. Income from other sources. He has sold all the shares on 1/10/24. So for the year 24-25 previous year, the sale consideration of all the shares being 4,000 per share through a recognized stock exchange and paid a brokerage. So 4,000, number of shares being 100. I am talking about original shares minus brokerage. Brokerage 1% in this case being 40 rupees. 3,960 will be the net sale consideration minus cost of acquisition. In this case, cost of acquisition is whichever is higher up, because original share purchased before that specified date. So whichever is higher up, come on. Number 1 being actual cost of acquisition. Number 2 being whichever is lower of. Number 1 being fair market value on which date? 31st January 18. Number 2 being sale consideration. Right. Now, what about the bonus shares, sir? In case of bonus share, sale consideration, how many bonus shares are there? 1:1 means bonus share will also be having the same number, 100 shares. Here the sale consideration being 4,000 minus net sale consideration means brokerage being 40 and net sale consideration being 3,960. Net sale consideration being 3,960. And what about the cost of acquisition of the bonus share? 0, because bonus share acquired after 31st Jan 2018. So fair market value means the value being 0 only. So the value being bonus share is allotted on 23 and sold on this date less than 1 year. So it will be considered as short-term capital gain only. So 3,960 short-term capital gain per share. So for overall shares, 3,96,000 will be the short-term capital gain in total. Okay. And 1% brokerage. What about the security transaction tax paid? Security transaction tax cannot be deductible as per section 48 provision 7. So, but it gives the indication that this provision the security transaction tax is paid at the time of purchase and sale means then automatically section 112A provision will be applicable. Okay. Apart from that, nothing will be taken here. And dividend received, dividend being part of income from other sources, 10 rupees per share on this date after the bonus shares. Original share 100, bonus share another 100, so 200 shares, and dividend declared being 10 rupees. So the ultimate value being how much? 2000 rupees will be the dividend. This will be falling under income from other sources. Okay. Now, compute his total income and tax liability for the assessment year 25-26, assuming that he is having no income other than the given above. Fair market value of the shares being 2000. So, the fair market value on the date being 2000 rupees. Sale consideration in this case being, okay, 4000. Actual cost of acquisition being 1000. So between these two, whichever is lower, between these two, whichever is higher will be taken. So automatically 2000 will be subtracted from here. 1960 will be the long-term capital gain per share. And if you add, if you multiply with 100, then total long-term capital gain in this case being 1960,000. 19,60,000 will be the 1,96,000. Yeah, 100 shares only. No, I thought 1,000 shares. Okay, 1,96,000 you gain. This is a long-term capital gain. This is a short-term capital gain. This is income from other sources. In Singar Academy text, the last component is to calculate the tax payable. I skipped that part. You can try it yourself after completion of the tax calculations part also. Clear? Now, we have completed section 45 class 1A, class 2, class 5, and 46 class 1, 46A, 49 class 1. This section is not required to mug up because section 49 is all about the mode of calculating or treating cost of acquisition in case we need to take the cost of acquisition not being the original one. You may purchase the debenture from XYZ company. Okay. For that, the payment may be 100 rupees. Sometimes later, you surrender the debenture and get instead of debenture equity share capital. The now question is, what is the value of the equity share capital? What is the cost of acquisition of the equity share capital? Originally, you purchase the debenture and the payment is made for the debentures only. But now, at the time of sale, you have only equity shares to be sold. You have not paid the money for the equity share capital. Then what is the cost of acquisition? Now, the question is, the equity share capital you received only due to what? The possession of the debentures. The price you paid for the debenture will be considered as the equity share capital's cost of acquisition. So that's why it is called deemed cost of acquisition under section 49. Most of the case you can guess it yourself. In simple sense, cost of acquisition for these cases will be equivalent to the cost of acquisition of the previous form. What is the previous form? Debenture. What is the current form? Equity shares. What is the value for, what is the cost of acquisition for the equity share capital? So I have not purchased the equity share capital by paying the cash, but it got allotted due to possession of the debentures. Then the cost of acquisition of the debenture becomes the cost of acquisition of your equity share capital. Clear? Hope now you'll be able to understand. If you are getting the assets by gift, will from your father or some other mode, actually you are not paid, then what is the cost of acquisition? Cost of acquisition of the previous owner will be taken, right? Very simple. Okay. So I've grouped that into angles. Cost of acquisition is equivalent to the cost of acquisition of the previous owner form. Like if you are getting after the partition of the Hindu undivided family, asset distributed to the members of the Hindu undivided family, and they get the assets as from their parents and others as an ancestral property. They are not paid. Then what's the cost of acquisition? Cost of acquisition of the previous owner will be taken under gift or will, success and inheritances, and on receipt of asset at the time of liquidation of company. Okay, you have seen that, right? Sometimes section 46 also we have referred. Okay, you might have invested in the company went for the liquidations. For the share, you will be getting what? You will be getting the assets of that company. Then assets value is what? Assets value is equal to the fair market value as in the date of distribution will be considered. Fair market value or the previous form, the shares value will be taken. In case of trust, gift under trust, okay, revocable, irrevocable. So that we'll study that along with the income from other sources content. In case of amalgamation and demerger, company A merged with company B. Due to this amalgamation, A's assets becomes now assets of B. And what is the cost of acquisition for that assets in the hands of B? The cost of acquisition of that assets by A will be considered. Cost of acquisition of the previous owner will be taken. And Hindu undivided family property, all these things again will cover along with the subsequent illustrations. So there is no any extra thing to be memorized here. Right. So these are the provisions we have. We'll study here or there in illustrations. There itself we'll understand this. So no need to worry about this particular section to be studied separately. Let's now start with this question. This question is all about section 50. As we already studied this section, along with the capital gain, PGBP chapter section 32, we skip this here. Okay. Machines put to use and all, depreciable assets. In case of depreciable assets, the depreciation will be calculated as per section 32. Once the block of asset becomes 0, then naturally what we have to do, we have to calculate the capital gain under section 50. We club this there itself, so we no need to study it separately. For the understanding, you can try to solve this yourself later. 50A is all about SLM basis. Also, we have studied this one also along with section 32. The asset used for the power generation companies, they have the options to depreciate their assets individually under SLM method or WDV method at the option. And in all other cases, group assets will be, group means block, okay. Same kinds of assets having the same rate of depreciation will be grouped into a block, and that entire block will be depreciated in single shot. And if the block exists even after the year end, then you are eligible for claiming the depreciation. If it is not so, you can claim short-term capital gain there, okay. 50AA over 50B, I told you to discuss this at the last. No need to worry about this one now. And 50C also we have completed. 50C is nothing but sale consideration is always compared to the stamp duty value. Sale consideration should not be less than stamp duty value, or you compare the sale consideration and stamp duty value. Between these two, whichever is higher will be taken. Okay, that's the provisions in order to avoid cheating the sale price, right? Similarly, 50CA is for unquoted share. We have studied this 50C, 50CA, and 50D. All the three completed earlier. Clear. And 55A is nothing but reference to the valuation officer, also completed. Okay. The most important content here being the section 47. Okay. So we have to cover the section 47 and then we directly move on to the deductions chapter here. Section 47. Now, you already we discussed section 2 clause 47. What is that? Section 2 clause 47 defines transfer. Okay, what are the things will fall under transfer? Okay, so if the capital asset falls the category mentioned under section 2 clause 47, then automatically capital gains will be considered and tax will be leviable. Clear? Like sale, extinguishment, and relinquishment, and partial transfer as per the Transfer of Property Act in case of properties case as per the Transfer of Property Act, and then even conversion of the capital asset into stock in trade. All these things are considered as transfer under section 2 clause 47. We refer the illustrations under section 47, 45 and onwards. If you remove the section 2 here, section 47 will come. So this transaction, the transactions listed under section 47, okay, is not considered as transfer. Okay, specified that this will not be considered as transfer. A transfers the property to B, residential house property transferred to B. But this transfer falls under section 47. Then while this transfer, capital gain will not be attracted. Capital gain will not be attracted. But while B transfers this asset to C, this falls under section 2 clause 47, then automatically what happens? The same residential house property, capital gain will be attracted. For example, A being father and B being son. A gives the property to B by will or after the demise of A may be transferred to B. Then this is not considered as transfer. So A purchased the asset for 100 lakhs. It is transferred to B, but this transfer is not considered for the taxation purpose because this transaction is not transfer as per section 47. Later on, B sells to C, who is friend of C. Friend of C. The sale consideration in this case being say 200 lakhs. 200 lakhs. Right. Now, as the sale consideration being 200 lakhs here, 200 lakhs here, how can you calculate the cost? So for him, there is no capital gain. For B, sale consideration being 200 lakhs. What is the cost of acquisition? Sir, B has not purchased it, sir. He is given this by way of gift from his father. Then cost of acquisition of the previous owner will be taken as per section 49. Just now we have studied. So which is 100 lakhs. You can subtract the 100 lakhs and balance 100 lakhs will be considered as your long-term capital gain. Of course, I have skipped the indexation as this transfer happens on 23rd July, like I assume. Is that okay? Subject to indexation benefit will always be there. Clear? Now, what are the items are listed under section 47? 47 is the depth section, so I have to study. We have to learn that in detail. All the content what we have covered under capital gains up to now, to that extent of weightage or time required to cover this particular section alone. Okay, but luckily at found inter-level only 30 to 40% portion is available in 47 section. Rest is taken to final. You no need to worry about that. Okay, it's comfortable. In final, you know, there's a separate chapter called amalgamation, merger, demerger and all, where this section 47 provisions related to that is discussed there. Okay, for inter-level, we are going to study here or there only. Clear? Now, section 47, section 47A, both are interlinked. Section 47 says some of the transactions are considered as not transfer. You don't need to levy the capital gains tax on satisfaction of some of the conditions. Some conditions will also be listed in section 47 itself. If those conditions violated later on, then the exemption given earlier, no, it is not considered as transfer. You don't need to pay the long-term capital gain. That's how a benefit is given for the transfer, falling under section 47. But there is some condition. If the condition is violated, section 47A will attract and says, hereafter you have to levy the tax for the exemption given earlier. So you have to study both section 47 and 47A. You have to study both parallel. Okay. So the transaction not regarded as transfer, that is, transfer of capital assets will not be considered as taxable purpose. But section 47A says withdrawal, no sir, it is taxable. 47 says not taxable. 47A says no. The exemption given is withdrawal, so you have to pay the tax. Why? Conditions levied. Conditions exist along with section 47. Sometimes later, if you are violating, automatically exemption given not being the taxable is now reversed. Now reversed. Is that clear? Hope now you'll be able to understand. So we'll now study these two put together. These two put together. We'll study one after one here. Now, this 47A predominantly applicable for these three scenarios. Now, Hindu undivided family to members in partition will be considered as not transfer. Any capital assets for the partitions of Hindu undivided family assets transferred to the members, then it is not considered as transfer. Later on, if the members are selling to some third party, then this will attract the capital gains. This will not be capital gains. And by way of gift or will, an irrevocable trust, okay, or an irrevocable trust, okay, then section 47 will be attracted. It's not coming under taxability. Okay, clear? Revocable and irrevocable trust is nothing but A gives his capital assets to B, stating that it may be revocable or irrevocable. Revocable means you can use this capital assets until I ask, or use it for 5 years and then return. So ownership and using rights transferred to B for a temporary period. After 5 years or after 10 years or whenever A wants it, B has to surrender. Then it is called revocable, returnable. Irrevocable means not returnable. Once for all, I have given, you can enjoy hereafter. I will not claim my ownership in this property later on. In case of irrevocable gift, then this will fall under section 47. Clear? Even revocable also most of the cases. But this will not be applicable for the ESOP. This will not be applicable for ESOP. In case of employee stock options plan, right? You cannot say that it's a gift, it's not taxable. No, sir, it is taxable only. If you are getting the means a share from your company as you are being the employee, okay, the fair market value in the amount you paid will be considered as perquisites and taxes already levied. So it's not free. For ESOP, this provision will not be applicable, even though it's gift from the employer. Clear? And next one being holding company to subsidiary company. If the asset transfer from holding company to subsidiary company, section 47 will be applicable. Means it is not transfer. It is not transfer. Provided, and the next case being subsidiary company to holding company. Okay, capital asset transfer, then it is also not considered as transfer. Provided the recipient company, you know, should be Indian company. Should be Indian company. Transferor company may be non-Indian company, no problem. Maybe foreign company, but recipient should be Indian company, and the holding status should be 100% holding. All the shares of subsidiary companies held by the holding company. Only then these conditions will be applicable. And of course, conditions also applicable for this. What are the conditions? Okay. Now, this capital assets, you know, this capital assets should not be converted into stock in trade. And this holding status should also be continued. For how many years? At least for 8 years. So, holding company at the time of transfer holds more than 100%. Matter of 3 months later after the transfer of the asset, he enjoyed the benefit. He now loses a 100% status, around the 5% shares sold out. Or the transfer capital asset is converted into stock in trade by the transferee company. In these two cases, the exemption given earlier under section 47 is now withdrawn as per section 47A. Clear? As per section 47A. So 47A exemption is withdrawn for 4 and 5 for these two. If within 8 years wholly owned subsidiary company ceases its status or converts capital assets into stock in trade in these two cases. So what happens then? Automatically, probably it transfers this way in year 23-24 previous year. But the capital asset is converted into stock in trade in the previous year 25-26. What happens, sir? Automatically, what happens? In 23-24, this transfer is not considered as a taxability purpose due to section 47 is now revoked back in that year is taxable. Sir, I already paid the tax and closed my accounts by filing the tax returns and all. No problem. You have to reopen that and pay the tax now. You have to reopen and pay the tax. Taxable in the year of actual transfer by the transferor company. This will be taxable only in which year? 23-24. Okay. You are in which year? You are in the previous year 25-26 because in the year 25-26 only you violated. As you violated only in 25-26, all the exemption given in 23-24 is now not valid. So you have to pay the tax for that period. But already tax returns filed, sir, no problem. Rectify under section 155 within 4 years from the end of the previous year in which 47A is attracted. So this is the previous year. From the end within 4 years, you can go and rectify and pay the tax for this year. From 26-27, 27-28, 28-29, 29-30. Within this 4 years, you can go and rectify this one and pay the tax along with interest. Is that clear? Now, what is the cost of acquisition, sir? So, as it's being the free transfer, usually in the hands of S, the cost of acquisition will be cost of acquisition of the previous owner H. But on withdrawal, what happens? The actual amount what S paid will be considered as cost of sale consideration for H. So, H transfers the capital assets to S, purchased for 100 rupees and sold for 150. And S never bother about 150. And H is also not considering this being the sale and no tax is leviable. But on violation, automatically the difference between these two will be considered as tax, means capital gain in this year, and the tax is payable only in this year, in the year of violation. Cost of acquisition thereafter for the transferee company is equal to the cost of acquisition paid. 150 will be considered, right? Let's now try to solve the illustration here. Okay. Now, SBB Limited transfers its machinery WDV of the block of assets being 2 lakhs. To its 100% holding company, SSA Limited, being Indian company, 100% holding status. Machinery transfer, plant and machinery transfer. The transfer date being 15/5/23 for rupees 2 lakhs 40,000 rupees. Sale consideration being 2.4 lakhs. On 31/7/24, SSA Limited converted such asset into stock in trade. So this capital asset is converted into stock in trade. When? 31st July 24. On conversion, the fair market value being 3 lakhs and sold all this converted stock for rupees 3.2 lakhs, sale consideration being 3.2 lakhs. When? On 17/8/24. SSA Limited had no such block of machinery. Show tax treatment. show tax treatment. Now, the actual transfer happens in which year? 23-24. So, previous year 23-24. Right. For SBB, not transfer. Not transfer. For SSA, no tax. By attracting section 47. Okay. In the year of transfer, it falls under section 47, so not transfer. No need to consider for the taxability. But two conditions should be satisfied. Condition one being this 100% status should be maintained for 8 years and should not be converted into stock in trade for 8 years. This one remains intact, no problem, but this is violated. As one of the conditions violated, automatically what happens? Section 47A will be attracted as per section 47A now. Okay. So you have to calculate for SBB Limited. Sale consideration being the value actually transferred between these two parties 2.4 lakhs minus cost of acquisition being 2 lakhs. Difference being 0.4 lakhs is short term capital gain. Okay. Calculated in the previous year, actual transfer 24-25. Okay, but this income related to 23-24. For this income, you have to pay the tax within 4 years after the end of this previous year. Within 4 years after the end of this previous year. The moment you violate, automatically tax liability will be attracted. Now, what happens in case of SSA Limited? For the previous year 23-24, no matter here. But for the previous year 24-25, okay, converting capital asset into stock in trade falls under section 2 clause 47. Am I right? Conversion of capital asset into stock in trade is also considered as transfer and capital gains will be attracted. The sale consideration is nothing but the fair market value on the date of conversion, which is 3 lakhs. Cost of acquisition is nothing but the acquisition cost you actually paid to the transferor, which is 2.4 lakhs, Now the difference between these two 0.6 lakhs will be your short-term capital gain. Later on, that converted stock is sold for 3.2 lakhs. That will be falling under PGBP under section 28. Sale consideration of stock in trade being 3.2 lakhs and fair market value also the date of conversion being 3 lakhs and the difference between these two will be your PGBP income. Clear? Now, we'll move on to the next illustration. SBB Limited acquired 100% holding interest being 1 lakh shares in SSA. So, SBB and SSA. 100% holding. 100% holding. Okay. On 10/10/2018, sorry, the share 1 lakh shares at rupees 10 lakhs purchased on 10/10/2008. On 16/2/2020, SBB Limited transfer its land. Land is transferred. When? 16/2/2020. Cost of acquisition being 5 lakhs. Originally acquired being, date of acquisition being 10/5/10 to SSA Limited. This land is handed over to SSA Limited for rupees 25 lakhs. Sale consideration being 25 lakhs. On 25/3/2025, SBB Limited transferred 2000 shares of SSA Limited for rupees 1 lakh. Right. In this folding, they say transfer 2000 shares at rupees 1 lakh. Show the tax treatment. Now, this happens in which date? 25/3/25. Come on. The original transfer happened in 2019/20. Am I right? 2019/20. Original transfer. At the time of original transfer 2019 and 20, for SBB as well as SSA, no need to calculate anything here because section 47 is attracted. Now, in the year 25/3/25, so previous year 24/25, from the date of such a transfer and to the date of transfer of sale, as this is less than 8 years, less than or equal to 8 years, they have now not fulfilled one of the conditions. That's nothing but holding the 100% shares for 8 years is not met now. So automatically in the previous year 24/25, this exemption given earlier as per section 47 provision no more will be valid due to section 47A condition applied. You have violated the condition. As per section 47A, now it becomes taxable. In this case, sale consideration being 25 lakhs minus cost of acquisition or indexed cost of acquisition. Of course, indexation is applicable up to 23rd July. This will be now applicable. You can do the indexation also, the value being 5 lakhs into inflation index applicable in the original transfer date 1920. The land originally transferred from transferred by SBB to SSA on 1920. What is the index value on the date? 289 should be the numerator value, and acquisition date being 10 and 11. 10 and 11, the index value being 167. If you do the cross multiplication, what's the final value? 8,65,269. Subtract to get the long-term capital gain. 16,34,731. Though it is calculated for this year, but related, this income is related to which year? Related to year 1920, 2019-20. Original transfer date will be considered. Original transfer date will be considered. Okay, plus for SBB, For the same previous year, he sold one of the shares, some part of the shares. Sale consideration of shares being 1 lakh, 1 lakh minus cost of acquisition of the share, cost of acquisition. 1 lakh share acquired for 10 lakhs, and for 2000 shares, come on, tell me what's the value of acquisition? 1 lakh, here numerator 2000 into 10 lakhs. 20,000, I think. I assume that indexation is not available, so 80,000 will be considered as long-term capital gain here. Long-term capital gain. This is related to what? This is related to 2024-25 only. This one is related to 2019-20 because of section 47A. Now we calculate. At the time of original transfer, it is totally exempted. We never bother about the calculation of capital gains due to section 47. But due to section 47A, in the year 24-25, he violated. So automatically, I recalculate that taxable income applicable for the year 1920. And in this current financial year, is transferred the share also. For that transfer of share will also be part of the long-term capital gain. So we calculated that separately. Now, what happens in case of SSA, sir? For SSA, cost of acquisition of this asset being 25 lakhs. At the time of sale, he can use this for subtraction purpose, okay, later on. Or if he wants to claim the depreciation, of course, he can claim the depreciation on this 25 lakhs. Clear as the case may be. Now we'll move on to the next one. In case of amalgamating company to amalgamated Indian company, also considered as exempted, not transfer under section 47. Demerged company to resulting company, in that case also not considered. But always remember the transferee company should be Indian company. Indian company. Right. Clear? Hope now you'll be able to understand this. So A company merged with B company. Thereafter A company is closed. Indian B company being Indian company. Then automatically the transfer of capital asset will be considered as not transfer under section 47. AB company where B is separated and formed a new company, while forming some of the capital assets of AB is transferred to B, also falls under section 47, provided the B should be Indian company. B should be Indian company. Right. Now, this one is pretty different and rare also. Understand that it's a foreign company. AB, where B is demerged and formed as a new company, also foreign company, maybe in UK, maybe in UK, right? So this transfer is not considered as what? Transfer. Okay, section 47 will be attracted. Now, shareholder from India who holds a share here, after the demerger, this shareholder gets a share from B also. Is that okay? Earlier in the combined company, he has 100 shares. After the demerger, he gets 100 shares from demerged company and another 50 shares in resulting company. This is resulting company. Okay, this is demerged company after the demerger. Now, what about for shareholders, sir? Okay, as he gets the new shares, right? Will it be attracting capital gains? No, not required. Not required. Okay. So during the transfer also not attracts, and for the shareholder he gets the shares. For that also it will not be attracted. It will not be attracted. In case later on shareholder transfers these shares 100 plus 50, these shares transfer. What is the period of holding? This AB exists more than 10 years. This is only 10 months. Now, after the demerger, this shareholder has company A's share, which is purchased 10 years ago. Resulting company shares he just now got a matter of 10 months ago. Though he received 10 months ago, this is only due to the possession of the original shares in AB. No. So, this will also be considered as 10 years holding. To determine whether it's short term or long term, this is very, very important. Period of holding for shareholders. Let's try to understand this along with an illustration here. Okay. Mr. Joseph has 1000 equity shares of X Limited that he acquired on 17/8/2013 through will of his father. Okay. Joseph. Okay. So he gets it from his father, Joseph's father. Okay. 1000 equity shares of X Limited. Received on 17/8/13. So received it from father will be coming at a gift or will. Section 47 will be there, so it's not transferred. His father acquired such a share on 17/7/2010 through gift from his father-in-law. So father-in-law. Okay. From father-in-law, Joseph father gets it by will 17/7/2010. Now what about the transfer, sir? Is it transfer? No, no, because section 47 is there. Mr. Z acquired such shares on 18/8/2000. So he actually acquired on 18/8/2000 before 1/4/2001 at rupees 20. At rupees 20. Then we have been given the fair market value. Fair market value will always be compared. The fair market value given on 1/4/2001 with the actual cost of acquisition. So between these two, whichever is higher will be taken. So 20 by default higher, so we can take that directly. We can take it directly. These two are not required. These two are to confuse you. On 31st March 2019, X Limited amalgamated with Y Limited. An amalgamated company issued its 3 equity shares for every 2 equity shares of the amalgamating company. Okay. So now what happens now? 3 shares are issued for every 2 shares held. So naturally, J will have 1500 shares. When? When? 31st March 2019. On 2/4/2024, Mr. Joseph sold 1000 shares of Y Limited to one of his friends. So to his friends he sells 2/3 means 1000 shares at rupees 50 each. Compute the capital gain. One of the interesting illustrations. This is not transfer. This is not transfer. In exchange of X Limited shares, now J gets a shares of Y Limited. Due to the amalgamation, if he gets, then it is also not transfer. Finally, the sale consideration being 1000 into 50, 50,000 rupees minus indexed cost of acquisition or cost of acquisition, as the case may be. As the case may be. I'll assume that indexation is not applicable here. I remove it. So simply I can subtract the cost of acquisition. J purchased or got it through section 47 provision. So he has not paid anything. And J's father also got this under section 47. Then the previous owner and prior to the previous owner's value will be taken. So 20 rupees. So 20 rupees per share. Purchased how many shares? 1000 shares. Now how many shares he has? 1500 shares. Originally he purchased 1000 shares of X company by paying 20 rupees each, 20,000 rupees. Now he has around 1500 shares due to the exchange. It means the 1500 shares costing only 20,000 rupees. So do not get any confusions. Cost of acquisition of the previous form will be taken. The current form is the equity share capital of Y, previous form being the cost of acquisition, means equity share capital of X. The cost of acquisition of equity share capital of X becomes the cost of acquisition of the equity share capital of Y. But there, 20,000, here it's only 1,500 shares. Now, come on, get me the value. I think it is 13.33. How many shares are sold? 1000 shares. I assume that indexation is not enjoyable here. So, 13,333 is the cost of acquisition. Your long-term capital gain in this case being 36,667. Clear? Yes, come on, make a note of it. Now let's move on to the next one. So, in case transfer of government securities, Indian government securities, by a non-resident to another non-resident through settlement security intermediary dealing, not considered as transfer. Redemption of sovereign gold bond will not be considered as transfer. Already we discussed the sovereign gold bond also in the previous class. Right, under section 48. Okay, sovereign gold bond, SGB. If it is held by individual and at the time of maturity, he surrenders and gets the cash, then it's called redemption. That redemption is not considered as transfer. Capital gains tax will not be attracted here. Capital gains tax will not be attracted here. I just go for the recapping here. Okay, I think here is. So redemption is exempted. Cross verify with section 47 SGB. Is that clear? So there I explained the provision. Here as per this section it is exempted. So that's how I now quoted here. Now, conversion of gold into electronic gold receipts or vice versa by vault manager, also not considered as transfer. Okay. Electronic gold receipts. You deposit, rather than fund, you can deposit the gold. After depositing, you will get the a security like. Okay, that is called gold receipts. Hold for 5 years or 10 years. After 5 years or 10 years, you surrender the gold receipts and get the gold back. That's the advantage, sir. So if there is a shortage in gold, the price may be shooted up, right? Gold price may be shooted up. I could still remember a matter of 2 years, the gold price got almost doubled, matter of 2 years. Again, within another 2 years, it will not be doubled. Okay, the bull rally for the gold price hike is over. Okay, if the bull rally is there, price is increasing tremendously, government takes some initiation. Like, okay, those who are having the gold in your bureau, ideally, you can also deposit with the government. Get the gold receipts. Okay. So you can deposit with the government and government will now circulate that in the market. So the gold availability in the market is increasing. What is the benefit for this, sir? You will be getting the interest to the extent gold deposited with the bank. Okay. So you are getting the interest rather than keeping the gold in your bureau. If you are depositing with the government, you will get the interest. It's not jewelry, understand? If I give my some jewels, necklace or something, 5 years later, if you are getting it back, it will not be same gold. Okay, it's only a bar like you got to convert this. So you deposit the gold and get the interest over the 5 years or 10 years period. After the 10 years, again give the gold receipts and get the gold back to the same quantity. What is the advantage here? Keeping the gold in bureau will not get any revenue except capital appreciation. Instead of that, if you are depositing, you will be getting the interest also, and you are now free from theft also. Right, so those benefits are there. That conversion is called here vault manager, done by the vault manager. Safe. Okay, vault is safe. The bureau, right? And donating. Okay, any capital assets like any work of art collections, archaeological important items, photograph, manuscript. Okay, Mahatma Gandhi's manuscript and drawing, Wausi, whatever it may be, those archaeologically important. If you are donating all these things to either government, university, national museum, art gallery, archive, and central government notified any other entity, those things will not consider as transfer. Capital gains will not be attracted. Now, XYZ company, Mr. A has purchased the debentures. Sometimes later, A gets a share instead of debenture. So getting share instead of debenture will not be considered as what? Transfer. Later on, A transfers the shares to some third party, then it's considered as transfer. Now, what is the cost of acquisition for the share? The cost of acquisition of the previous form, debentures, will be considered here. Bonds, debentures, debenture stock, debenture certificate converted into shares or debentures. And in this case, cost of acquisition as per section 49 clause 2A already we have referred section 49 related to the cost of acquisition, deemed cost of acquisition when we don't have exact cost of acquisition for the assets you have. The asset what you have currently in the share, you have not actually purchased, so cost of acquisition of the share is not considered here. Then cost of acquisition of the previous form of the share, which is nothing but the debenture. So debentures purchase price will be your cost of acquisition as per section 49 here. And period of holding includes the period of holding of the previous form. So this was purchased in 1/1/2020. You got the share only on 1/1/2025. So you thought to sell on 1/2/2025 within 1 month period itself. What's the capital gain nature? Long term or short term? It's a long term, because we should not consider this date of purchase. We have to consider from the original date of purchase of the debentures to the sale date of the share will be the period of holding to determine the period of holding, whether it's short term or long term. Clear? The same case for this one also. Preference shares. Rather than debenture converted into shares, now preference share is converted into shares. The last part of section 47. The last part of section 47. Now, reverse mortgage. Reverse mortgage. The reverse mortgage, which is a scheme notified by the central government, will not be considered as transfer. Reverse mortgage. Is that okay? Now, see, A works for a long period to purchase one house property. Purchasing the house property is equivalent to his life, usually. How many house properties you have, your parents? Or you have, or your parents are having? How many house properties? 10, 20. If it is 10, 20, I don't come to your class, sir. And those who have completed construction, just ask them. Almost 20 years of my life for constructing the house property. So 20 or 25 years you spend for constructing one house property. After that, you become no more to work. Buddha Atmi. Okay. So you're not able to work thereafter. So you need money thereafter to survive. What you can do? Go to the bank and deal in the reverse way. Sir, I want to purchase the house property. Give me the loan. I will pay the installment month on month until my retirement. So at the age of 25, he borrows the money and purchases the house property and starts paying the EMI. Means starts working for the bank indirectly. You are getting employment for the banker, like. Okay. You start work for the banker for 25 to 55 or 60 up to the date of retirement. Exactly by 55, you close the loan and be happy. Oh my God, now the house property is completely in my name. Then retirement comes. What happens with the remaining life? So I need to get some money to eat. Okay. I don't have the job. What can we do? Go to the same banker and deal other way. So I paid the money. I purchased the house property. I paid the money installment. Now in a reverse case, you take the house. Not now. 30 or 40 years after. Up to that period, you pay the installment to me. This is called reverse mortgage. Mortgaging in a reverse manner. You are selling the house to the banker for a monthly installment. So, A and banker. For this option, you definitely have house property. Right. Who you are? You should be a senior citizen in this case. Okay. You are senior citizen. Only this case will be applicable. You give your residential house property to the banker, yet you are allowed to live in the same house property, no problem. Banker will make the payment to LIC. For what? Consideration for annuity. Consideration for annuity. Okay. Now LIC will release annuity every period. Periodical payment is named as annuity, maybe pension like. So now Mr. A is happy to live his final days decently. Okay. decently. Okay. So, A is now safer for the remaining life. He will be very comfortable to get the consistent return from the bank. From the bank. Is that okay? Either the consideration payable to LIC directly as an annuity fund, thereafter LIC will make the payment period. It's not LIC, any company. Or banker may release directly to A what? For any emergency settlement. Also possible. So there's a huge expenses for me, sir. There's a medical emergency around 3-5 lakhs. There will be immediate requirement. I can pledge my house property, mortgage my house property to get this money for my medical emergency, or helping my son to get settled in his life, whatever it may be, some emergency reason, you can borrow this. Not for what? Speculation business, sir. I want to pledge this and invest in the stock market. No, it's not so. Already you are in the age of counting. So, as you are in the age of counting, you are going to play. And monkey jumping or what? That jumping? Monkey jumping. You don't play here after those games. So that's how the cases are there. Now A gets the money in installment periodically from the banker. How long? Keeps on getting. After the expiry of A or death of A, bank will sell the property to third party. Okay. After selling, the amount paid in installment or lump sum money, whatever it may be, together with interest is subtracted from the sale consideration, balance is remitted to legal hire of A. While closing at the last, first chance of selling this is given to the legal hire of A. Maybe the house property given by A to banker. Banker says, today, the amount paid by banker to A for his survival by way of either pension or lump sum consideration comes around rupees 50 lakhs. And interest applicable for this are around 25 lakhs or 75 lakhs. If the residential house property is saleable, he may get 100 lakhs. Then the difference between these two, 25 lakhs, is considered as gain or leftover amount will be remitted by the banker to the legal hire. But this is the second option. First option is what? First of all, it is offered to A's son. If A's son or daughter comes, sir, I will take this house property. What's the amount I have to pay? Only 75 lakhs. The due should be paid by A's son and he can or she can take the property here. Okay. What happens? A, can he himself settle this? Yeah, of course. Suddenly, after 75, 80, surprisingly purchased a lottery and won 100 crores. Will he be able to purchase it back? Of course. Okay. Anyhow, that game also be happening then. Hope you will be now able to understand. Here, the asset transfer from A to banker is not considered as a transfer under section 47. So, it is not considered for the taxation purpose. This one is called reverse mortgage. This reverse mortgage is exempted. Okay, exemption of income on transfer of property to bank. This is not taxable. This is not taxable. As asset is transferred from A to bank, it is not taxable. Section 10, clause 43. You know that section 10 is all about exemption section. So here section 10, clause 43 is all about reverse mortgage. Applicability. This will be applicable for whom? Senior citizen, of course, should possess residential house property. If you don't have the house property, you will not eligible. So at least you have to purchase house property for this. To do what? Mortgage the residential house property with a scheduled bank or housing finance company. You can mortgage this. For what? Get a loan for lump sum amount or periodical income and includes indirect disbursement. This is called indirect disbursement. Banker pays to LIC, LIC makes consistent payment to me. That's called indirect disbursement. This will be direct disbursement. So, A gives the house property to bank and bank gives this amount for LIC and this LIC thereafter using this money gives some benefit to the mortgager. And maximum loan period being direct distribution case is 20 years. Indirect distribution, residual lifetime of the borrower. In case of direct distribution for the medical emergency, I want to settle my son's daughter's life for marriage and any business setup. Of course, you can borrow. That money will be settled within 20 years. No, sir. For my remaining life, I need to get pension life revenue periodically. Okay, you can get it also, no problem. In that case, until death, he can get the pension. After the death only, the asset is transferred to the third party. Any leftover amount after deducting the loan and interest remitted to the legal heir of the person. And what happens in case of 20 years or 30 years? The house property value is increasing, right? So once in every 5 years, the house property is revalued based on the market value applicable by the time, and based on the revised value, his contribution may also be increased. So it is anyhow adjusted for the pension money, means that inflation also. Note, the senior citizen can continue to live in the same house. The loan will be given up to 60% of the value. Okay, the property valued at 100 lakhs and 60 lakhs alone will be offered for the loan purpose, and it is revalued once in every 5 years. Once in every 5 years. Okay, loan can be used for what? Extension of residential house property, family medical and emergency expenditure, etc. And loan cannot be used for speculative or trading purposes. On death of the borrower, the lender either settlement to the legal heirs. Okay, the lender legal heirs means sale consideration minus loan and interest. Okay, this will be paid by the lender, banker, to the legal heirs. That's one possibilities. Preference will be given to the legal heirs to repay the loan before the sale of residential house property. This is a preference number one. Second option is this one: sell and get the money. Using that money, close the debt. Loan along with the interest is closed. Balance is remitted to the legal heir. Clear? Hope you will be now able to understand the reverse mortgage case. Majority case related to section 47 is over. Applicable to the extent of inter is over. Clear? If you have any doubt, you can ask me. Else, we will now move on to the next content. I think in this class, I may complete at least one or two deductions. The next class, I will complete fully. Okay? If it is clear, text me. Now, section 10 clause 37, urban agricultural land. Okay, rural agricultural land is not going to be taxable because it's not capital asset at all. We already studied that. What are called capital assets. Under that, rural agricultural land will not be considered as capital assets, so not taxable. In case of urban agricultural land, okay, now exempt if this urban agricultural land, okay, urban agricultural land used for agricultural purpose at least 2 years, either by the assessee or his parents, and it is compulsorily acquired under the law. And then the consideration is also determined by the central government or RBI. Central government and RBI, very important. It's not state government. Then automatically this will not be taxable. This will not be taxable. Urban agri land used for the agricultural purpose at least by the assessee or his parents at least for 2 years, and compulsorily taken by the government and consideration fixed by central government or RBI, then this will not fall under capital gain. Amount received by a non-resident towards compulsory acquisition of urban agricultural land in India by central government. What about the status? Taxable because non-resident. It is applicable only for individual or half being the resident. Okay, being the resident. Okay, here it's exempted only. Sorry, I stand corrected. Individual or huff, resident, non-resident, not a matter. Resident, non-resident, not a matter. Okay, I stand corrected. Sorry. Okay. Now, exists possession of agricultural land situated in urban limit, which is used for agricultural purpose during the preceding 3 years. Also, agricultural land is okay, urban limit okay, 2 years at least by either he himself or his parents okay. On 4/4/2024, this land is compulsorily acquired by law. That is also correct. On a compensation fixed and paid by 10 lakhs, advice X as to tax consequences, assuming that the entire amount is invested in purchase of shares. Okay. Yeah, of course. Eligible. Whether he uses the consideration for speculation purpose or valid purpose doesn't matter. It is exempted only. But the government should be what? Either central government or RBI. Okay. That one condition is very important. Where an urban agricultural land owned by an individual continuously used by him for agricultural purposes for a period of 2 years. So this also okay, this also okay. And is compulsorily acquired under the law and compensation fixed by state government. State government will not be eligible. Clear? Next question. In December 2024, Mr. Dev received 24 lakhs by way of compensation and 12 lakhs by way of interest and compulsory acquisition of his agricultural land within city limits of Chennai by National Highway Authority. Consequences to the court order, he incurred 2 lakhs towards legal expenses. The acquisition of his agricultural land was in the year 2017 and it was used for cultivation for the past 5 years. The compensation award was approved by the central government. So this one is okay, everything is clear. But the compensation for the asset will be considered as exempted but not interest. In case of compulsory acquisition, the compensation is delayed in the government's angle, you may get interest also. If you are getting the interest for the delayed compensation, already we studied along with the compulsory acquisition under section 45. Okay, if you are getting any interest, that will be falling under income from other sources and taxable in the year of receipt subject to a deduction of 50%. The same again we refer under income from other sources heading also. Is that okay? Income from other sources heading. Now, in case of zero coupon bond, what happens? Also be exempted under section 10 clause 47 on satisfaction of some of the conditions. The bond is issued by any infrastructure capital fund or company and there should not be any payment. That's what about the zero coupon bond. Already we studied along with section 36 class 1, right? Subclass 3A. Okay, zero coupon bond, right? PGBP. In PGBP, okay, specified deductions related items we discussed under section 36 where 3A, section 36 class 1 subclass 3A, we referred the zero coupon bond in detail there. Here the same is mentioned. But the income of transfer of zero coupon bond is equal to the capital gain if it is not held as stock in trade, but taxable at the rate of 10% without indexation. Transfer means maturity and redemption. Both will fall under this case. Under section 2 clause 47 we have seen maturity and redemption of zero coupon bond is also considered as transfer taxable. Tax will be applicable here also. Section 2 clause 48. Okay. Now we'll start with the deductions component here. So if you are able to memorize this particular page along with these notes, this entire chapter is over. We are supposed to complete the capital gains fully. Okay. We have been given 5 sections. You can claim the deductions from your capital gain under these 5 sections. Once you complete all the 5 sections, the chapter is over. Okay. Let's now start one after one. Now, let me finish up section 54 first of all. Let me finish up section 54 first of all. Okay. You can sell the residential house property and purchase the residential house property to claim the deductions. Very simple. You sell the residential house property and then using the capital gain because of selling the house property, you can purchase a new house property. No problem. You can claim the deductions. Clear? Very simple. Some additional conditions you have to understand here. Some additional condition. This section 54 will be applicable only if it is being the long-term capital gain, not for the short-term capital gain. Okay. So in case of land, building or land and building, okay, in those cases, you will be eligible for claim the deductions only if it is being the long-term. Okay, not being the short-term. Not being the short-term. In case if you have the short-term capital gain, you cannot claim the deductions. Right. So you have to understand section 54, it should be a residential house property. Sale asset should be residential house property. Purchase asset should also be residential house property. Right. Now, how many residential house property can be purchased? I sold one house property. How many assets can be purchased? I can purchase in general one more house property. I sold and I replaced one new asset. No problem. Provided on sale, the capital gain is more than 2 crores, then I am eligible for purchasing only one house property. If the capital gain is less than 2 crores, less than or equal to 2 crores, I can purchase 2 house properties only once in lifetime. Only once in lifetime. So, in year 24-25, I purchased, I sold my residential house property held for a long time and I purchased a new one, no problem, I am able to enjoy. Matter of 2 or 3 years later, again I sell and I can purchase. Another 2 or 3 years, again I can sell and I can purchase. If it is being the long-term capital assets, you can enjoy the benefit. But because of sales, my capital gain is less than 2 crores. How many houses I can purchase? 2 houses can be purchased. Okay. So I sold one house. The profit is 1 crore 50 lakhs. I can purchase 2 house property, no problem. 4 years later, I sell one more house property for getting a 3 crore rupees profit or 1.5 crores profit. Can I purchase another 2 house properties? No, you cannot purchase because purchasing 2 house properties is possible only once in your lifetime. Once in a lifetime. But if the capital gain is more than 2 crores, you can purchase only one residential house property. Sir, seems to be illogical, sir. If I have the long-term capital gain more than 2 crores, then I can purchase 2 house property. If you have long-term capital gain more than 2 crores, what will be your nature? You will be high net worth individual. You have so much huge money. So, will you purchase a house property with 40 lakhs or 50 lakhs in a cramped road? You'll go for the bungalow only. So, the price is always more than 2 crores. That's what of an intention. Okay. Hope you'll be now able to understand. If your capital gain is less than or equal to 2 crores, you can purchase 2 house property within the same limit. If your amount is more than 2 crores, your new house asset purchase should be restricted to only one. You can go for any number of, any size building also, no problem. Clear? Hope now you'll be able to understand 1 and 1 is over. Now, sir, do I want to purchase? Can I construct, sir? Yeah, of course you can purchase or you can construct. If you want to purchase, date of sale. From the date of sale, 1 year earlier, 2 years later. Within this period, you can purchase for the claiming deductions. From the date of sale, within 2 years you can purchase or earlier to that, within 1 year you could have sold. I have one house property. I purchased one more house property, sir. 6 months later, I sold one of the house properties. Can I claim the deductions for the newly purchased house property which was purchased 6 months ago? Yeah, of course. Where do I live, sir? If I don't have the house property, I have only one house property. To live, I need to purchase one house property. I shifted my family there. Thereafter, the old property is sold. So, you are given 1 year excuse also. From the date of sale 2 years later or earlier to that 1 year, within that 3 years window, you can purchase new asset for claiming the deductions. No, sir, I'm not going to purchase, I'm going to construct. No problem, you can construct. When will you construct? From the date of sale, within 3 years, you can finish up constructing. This is 2 years, this is 1 year. Hope now you'll be able to understand. Okay, clear. So you can either purchase or you can construct. You can do one of these two. If you want to purchase, 3 years limit is there, but the 3 years limit is totally different. If you want to construct, within 3 years, you can construct. Finish up construction within 3 years. But the limit is different. Clear? Now, maximum how much long-term capital gain can be claimable as deductions are only 10 crores. If your long-term capital gain is 15 crores, you thought to purchase another house property for 17 crores. How much I can claim the deductions? Only 10 crores can be deductible. Only 10 crores. Okay. Will it be applicable for you in your life? Or you get the client for whom this will be applicable? Okay, if you are getting the client to whom these provisions are applicable, then your fee will be in lakhs. Do you want to get the fees in lakhs or do you get fees only in thousands or hundreds? Depends. So you can interact with the article students, they will tell you. Okay, the nature. Okay, hope you will be now able to understand. Now, the new house property you purchase now should be in India. These are the small information you can understand. Before you study all the provisions, the main thing you have to understand is sell the residential house property, buy the residential house property. Okay. Is it purchase? No, sir. It may be either purchase or construct. In case of purchase, sir, 1 year earlier, 2 years after. In case of construction, only after 3 years. Is there maximum deductions available, sir? Yes, only 10 crores. After selling, how many house properties I can purchase? Check your capital gain being less than or equal to 2 crores or more than. If it is less than or equal to 2 crores, then you can purchase 2 house properties. If it is more than 2 crores, then you can purchase only 1 house property. Only these things you have to understand. Clear? And this will be applicable only when the gain being long-term nature as well as applicable only for the individual and half. So we have seen what? 7 categories of persons: individual, half, firm, company, trust, whatever it may be, right? AOP, BOI. After the class, where will you go? To your own home. After the class, where will the Singer Academy go? Will it be here only? We don't have the house property for the companies, right? So the house property logic is not applicable for the other associate other than individual and half, right? Should not claim any doubt here. Okay, only individual and half required the house property, right? So that's how you can easily now remember the points here. Clear? Let's now start with the illustrations. So especially the deductions, if I want to complete all the 5 deductions, by today itself, I can cover all the 5 deductions itself. No problem. Very simple. Okay. For every deductions, 10 minutes. In a matter of 1 hour, I can finish off. But I have incorporated all the advanced illustrations related to the deductions and capital gains in this chapter. So only I need extra class. So further reference not required for this particular content. Okay. All the illustrations are solved here itself in Singer Academy text. Right. We'll start with one illustration here. Tina was a owner of 2 residential houses on 5th April 2023. So house property 1 and house property 2. She disposed one of the houses and replaced the entire sale process to construct the first floor of her second house. So she sold this. Amount is used for constructing the second floor here. This is a newly constructed one. C. She seeks your advice to the taxability of the transactions to capital gains under the provisions of the Income Tax Act. Okay. Will it be considered for the deductions? Of course, she can enjoy the deductions. The house property will be considered as 2 units and both the units will be considered as house property only, eligible for deductions claiming. Clear? Eligible. This is unit 1, this is unit 2. Like she may claim 2 house properties. Eligible. Now, Mr. C purchased residential house property in July 2022 for rupees 10 lakhs, made some additions to the house property incurring 2 lakhs in August 2022. He sold the house property in April 2024 for rupees 20 lakhs. So sale consideration being 20 lakhs minus cost of acquisition being 10 lakhs minus cost of improvement being 2 lakhs and 8 lakhs being capital gain. From the purchase date to sale date, how many years are there? 23, 24, less than 2 years. If it is less than 2 years, then we'll be considering this being short-term capital gain. This is called short-term capital gain. Out of the sale proceeds, he spends 5 lakhs to purchase another house property minus section 54 deduction. Will it be possible? No. Section 54 deduction is possible only if the long-term capital gain being the long-term. Here the capital gain being the short-term, you are not eligible for claiming the deduction under section 54. So taxable short-term capital gain in this case being 8 lakhs. Clear? We will move on to the next one. Online students, come on, respond me. Once it is clear, text me. Now, Mr. SSI earned long-term capital gain rupees 2 crores on transfer of residential house property and acquired residential house property for 3 crores in the assessment year 25-26. The newly purchased residential house property is sold on this date for 5 crores. So, long-term capital gain being 2 crores minus deduction under section 54 being 3 crores, though it is 3 crores restricted to the long-term capital gain only. Always remember, after claiming any deductions, it should not be negative. So, taxable value being 0. This happens in assessment year 25-26. Okay. Now, in case the newly purchased asset sold sometimes later, when sold on 1/7/25, sale consideration being 5 crores minus what is the cost of acquisition? This one purchased on in the year 25-26, in the year 25-26, in the previous year 24-25 purchased, in the previous year 25-26 sold. Within 1 year it is sold. Now, one more additional condition I am going to guide you here. The asset purchased for claiming the deductions should be held for at least 3 years. At least 3 years. So, one more point. Okay. Withdrawal of exemption. The deductions I have given will be cancelled, withdrawal, when? If the new asset transferred within 3 years. So, all the points are now over. So, the newly purchased assets or constructed assets should be kept for at least 3 years. If you are not doing it, then automatically exemption given is withdrawal. Then how this will be calculated? Cost of acquisition of the newly purchased asset should be now this one, cost of acquisition minus deductions claimed under section 54. The cost of acquisition being 3 crores. Deductions already enjoyed for this asset being 2 crores. 1 crore will be your new cost of acquisition. So 4 crore will be taxable. Don't argue, sir. I purchased it for 3 crores, sir, sold for 5 crore, only 2 crores. No, 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 no. Already I have given the exemptions previously and stating the condition that you have to keep this for at least 3 years. You have violated, so automatically what happens? From the cost of acquisition, exemption given earlier will be cancelled. Okay. So only 1 crore will be considered as adjusted cost of acquisition. On that, to that extent, you have to subtract from the sale concession to pay the capital gain tax here. This will be the long-term capital gain here. Almost majority points are over related to 54. We'll see another 3 more illustration in same 54, incorporating some other adjustments like section 51 and 50C and all. What is that 51? For feature of advance given. 50C is all about stamp duty value and sale concession compared between these two, whichever is higher will be taken. So those things are going to be incorporated. Topic is over. 54 is over. In 54, all the points are over. Okay. Let me summarize all those points here. What are the points are there? Eligible for claiming the deduction should be long-term capital gain on transfer of residential house property. This will be eligible only for the individual and HUF. And this capital gain should be long-term nature. And you can claim the deductions by purchasing one new residential house property purchased if your capital gain is more than 2 crores. If the capital gain is less than or equal to 2 crores, then you can claim you can claim 2 residential house properties. This 2 house property deductions will be applicable only once in your lifetime. And of course, the maximum deductions is possible only to the extent of 10 crores. And the new residential house property either it can be purchased or constructed. Either purchased or constructed. In case purchase, it should be purchased within India. Either 1 year earlier or 2 years after the date of sale you can purchase. In case of construction, within 3 years after the date of sale will be purchased. The newly purchased asset or constructed asset should be kept with you for at least 3 years, else the deductions given will be withdrawn. The same will be applicable for 54B and 54D also. Okay. Once you are master with 54, automatically rest will be easily, you can cover it. Okay. That's why I am giving lots of examples for 54. And now remember, within how many years you can keep it? You can construct this within 3 years. What happens with that sale consideration? Sir, can I keep that sale consideration in my bank account? No, you cannot keep in your own bank account. It should be deposited in a specific capital gains deposit scheme account. Otherwise, it is considered as misused. Okay. Deposit unutilized amount in capital gains account scheme. Within which date? Before the due date of filing of return of income. Within that period, that amount, unutilized amount should be kept. The moment you start constructing or purchasing the later on, the amount can be transferred from the capital gain account scheme to the buyer or to the payee to whom you are paying, right? Now, SSA earned a long-term capital gain 12 crores on transfer of residential house property and acquired new residential house property for 8 crores. How much can be subtracted? Section 54 deduction being only one house property is possible and that too maximum 10 crores. Okay. So, cost of acquisition of the new house property 8 crores, maximum deduction being 10 crores. So 8 crores can be deductible. So balance 4 crores is a taxable capital gain. Here long-term capital gain being 15 crores and acquired new residential house property. Okay. At rupees 16 crores. Calculate the long-term capital gain. So, though there is a limit, there is a investment more than 10 crores, the limit is only 10 crores. For how much you can claim the deduction? 5 crores will be taxable long-term capital gain. Clear? Now, section 54 and 51. Hari has acquired residential house property in Delhi on 15th April 2005 for rupees 9 lakhs and decided to sell the same on 3rd May 2008 to Mrs. Pari, and an advance 25,000 was taken from her. The balance money was not paid by Mrs. Pari and Hari forfeited the entire sum. If any amount forfeited, then this will be automatically subtracted from the cost of acquisition. Before indexation. Before indexation, it should be subtracted. On 3rd June 2024, he has sold the house property to Mr. Suri for rupees 40 lakhs. So, sale consideration being 40 lakhs. Okay. On 4th April 2024, he had purchased a residence house property in Delhi for rupees 8 lakhs, where he was staying with his family on rent for at least for the last 5 years. So he purchased one more house property, no problem, and paid the full amount as per the purchase agreement. However, Hari does not possesses any legal title on this date. So legal title is not a matter. As per the Transfer of Property Act, the payment is made and possession is taken up, and agreement is written to transfer that later on will be considered as transfer only. So transfer took place in that year. So you can claim the deductions here. Right. As such, a transfer was not registered with the registration authority. Okay. So you can claim the deduction. So what is the cost of acquisition? Indexed cost of acquisition. Okay. 9 lakhs. As per section 51, this 25,000 should be subtracted. And you can do the indexation. Current inflation index being 363. Inflation index applicable in the year of purchase 2005 and 6, 117. Then the ultimate value being 27 lakhs 14,744. Okay. Indexed cost of acquisition. Then your long-term capital gain in this case being 12 lakhs 85,256 minus section 54 benefit. A new house purchased for 8 lakhs can be subtracted. Hari has purchased another old house in Chennai on 15th October 2024 from X, an Indian resident paying another 5 lakhs, and purchase was registered with the appropriate authority. So he had made another purchase. So you can claim that one also be deductible. 2 house properties are allowed as the capital gain is less than 2 crores. If I subtract these two values, 13 lakhs, of course, restricted to only to the extent of 12 lakhs 85,000. So you can restrict this to 4 lakhs 85,256. 0 will be the taxable. 0 will be the taxable. Is that clear? And of course, if you have the options to claim without index, no index. In case of land or building, land and building, in case of individual and HUF, they have the options to either go for indexation or without indexation. If without indexation means 40 lakhs, indexed cost of acquisition will not be considered only, cost of acquisition will be taken, so 8 lakhs 75,000. You cannot do the indexation. So 31 lakhs 25,000. How much you can claim the deductions? 8 lakhs and 5 lakhs, 50 lakhs you can claim the deduction. If you subtract both, what is the taxable amount? 18 lakhs 25,000. Okay. As per your option, you can go either indexation option or without indexation. You can calculate both the method, and the method gives you more beneficial to the assessee. You can choose that one. Is that clear? Hope now you'll be able to understand. Now let's move on to the next one. Clear? Text me. Another two more illustrations dealing with section 54 in addition. We try to finish up these two sections, these two illustrations by today. Make it faster. Make it faster. Now, where the long-term capital gain in this case is more than 2 crores. From this, it is very clear you can enjoy investing only in one new house. Mr. Ganesh sold his residential house property in Mumbai and earned a long-term capital gain of rupees 2.5 crores. 2.5 crores. Okay. He purchased two residential house flats adjacent to each other on the same day via two separate registered sale deed. So in a complex or residential flats, two house properties, two unit houses purchased nearby, two flats. And the builder had certified that he had effected necessary modification to make it one residential apartment. So he converted that into one residential house plot. So rest of all the house properties are this much size only. He purchased two flats and converted that into the one flat. And he got the certification from contractor also. Mr. Ganesh sought exemption under section 54 in respect of the investment made in purchase of the two residential house flats. The assessing officer, however, gave exemption under section 54 to the extent of purchase of one residential flat only, contending that since the long-term capital gain exceeded 2 crores. And the two flats cannot be treated as one residential unit. Since the flats were purchased through different sale deeds and it was found by the inspector that before its sale to the assessee, the residential flats were occupation of two different tenants. That's how they disqualified this one. The final answer, verdict is in favor of the assessee only. You can claim these two. Okay, these two will be considered as one residential house property only. We have already studied in income from house property. Okay, so deemed to be let out and all. If we have 3 or 4 residential units within the same flats and I occupy all the 3 and 4 will be considered as one only. The same logic will be applicable here also. Two flats merged into one flat and I am occupying this entire thing as my single flat. Of course, I can enjoy the benefit. Hope now you will be able to understand this. Next illustration. This is all about discussion illustration. Actually, it is given as a judgment in a case law. Commissioner of Income Tax and Ananda Pasappa. Okay, in 2009, judgment is given in High Court. And for that, the evidence is nothing but the builder certification for modification is added here and it is situated nearby. This is how the conclusion is given in favor of the assessee. Now, let's move on to the next illustration where we are going to cover section 54 as well as 54C. Already we covered section 54C, isn't it? As per section 54C, the sale consideration is compared with the stamp duty value between these two, whichever is higher will be taken. Okay. Now the question is which date stamp duty value will be taken. Okay. So in this illustration, we have been given 3 dates of stamp duty value. Okay, stamp duty value for 3 different dates. Now, a small amount transferred through bank account and a writing deed is prepared between the buyer and seller stating that it is going to be settled in due course. Then that date, that agreement date will be final. But if the consideration is transferred in the form of money without any other solid evidence, then registration date stamp duty value will be final. Is that clear? Next one is that section 50C is applicable only if the stamp duty value is more than 110% of the sale consideration. Else 50C will not be applicable. So these are the provisions you have to understand. And that will be clearly explained in this particular illustration. So I have added here. Mr. Sattak entered into an agreement with Mr. Jay Kumar to sell his residential house located in Kanpur on this date for 1 crore 50 lakhs. The sale proceeds were to be paid in the following manner: 20% through account payee, bank draft, and agreement is also made. 60% on the date of possession, balance after the completion of the registration. Even a small amount transferred by way of the bank account and there is an agreement, that date stamp duty value is final. Okay, this date stamp duty value is not considered. This date stamp duty value is also not considered. Mr. Jay Kumar was handed over the possession of the property. The possession date is not a matter. And then the registration process got completed on this date, also not considered. Because a part amount and token of advance like transferred by way of account pay check or bank account through bank account, that date will be final for the stamp duty calculations. So the value determined by the stamp duty authority given here for different dates. Now which date is final? Date of agreement. Okay. Here 1512 is nothing but possession given, that is not a matter. And 14.1 is nothing but registration date, also not matter. And the entered agreement to sell on 16/8 on the date account pay check through account pay check, a part payment is made and agreement is also made, then this one is final. So stamp duty value in this case being 170 lakhs. Sale consideration is 150. Now cross check whether 50C is applicable or not. Okay, if stamp duty value is more than 110% of sale consideration, then only 50C is applicable. Stamp duty value is 170 and check 110% of sale consideration. The sale consideration in this case is 150. 165, yes, applicable. So 50C is applicable. Now the sale consideration in this case being 170 lakhs, which is nothing but whichever is higher of sale consideration as well as stamp duty value. Okay. Minus cost of acquisition or index to cost of acquisition. Mr. Sattak acquired the residential house property at Kanpur on 1/4/2001 for 30 lakhs. So 30 lakhs, current inflation index being 331 divided by inflation index in the base year being 100. Then what is the final value? 108.90 lakhs. So your long-term capital gain in this case being 61.1 lakh. Now you can claim the deduction under section 54 if any asset purchased. After recovering the sale process from Jay Kumar, he purchased 2 residential house properties. Will he be eligible for 2 house properties? Of course, long-term capital gain being less than 2 crores. So he is eligible for purchasing 2 house properties. One in Kanpur for 20 lakhs, another in Delhi for rupees 35 lakhs. These two put together, you can claim 55 lakhs as deductions. So the purchase should be done within 2 years from the date of sale of this asset. If you have not purchased, then the amount will be kept in a separate deposit scheme. Okay, that is not considered here. Okay, before the due date of filing of return, maybe 31st July, before that he has purchased another house property, not required to deposit anything. Now find out the difference. 6.1 lakh will be considered as taxable long-term capital gain. In case, if you add no indexation, what happens? 170 lakhs, this is 30 lakhs is directly subtracted. So 140 lakhs will be considered as long-term capital gain and 55 lakhs can be deductible. So balance being how much? 85 lakhs is the taxable one. Taxable value. If apps no indexation benefit. Apps no indexation benefit. Clear? Rest of the 4 deductions, any doubts here?
363. 30 lakhs into 363.
Oh, 363. Okay. That's your doubt, huh? Because I'm constantly watching your face and found some surprise in your face, huh? You have to intimate me, right? Okay. Anyhow, the logic is very simple. So rest of the sections we can complete comfortably in the next class. Okay, one session is more than enough for the remaining 4 because the most detailed section is 54.